You know that comforting feeling on payday, right? You check your banking app, your salary has officially hit, and right on schedule, a chunk of that money has been automatically spirited away into your 401k or IRA. Out of sight, out of mind. It's kind of the ultimate set it and forget it financial strategy. And honestly, it helps a lot of us sleep at night. But today we need to investigate a deeply fascinating and frankly, slightly alarming concept that operates right beneath the surface of all that comfort. It's called the passive investing death spiral. We're going to explore whether the widely accepted conventional advice about your retirement fund is actually masking a massive, systemic macroeconomic risk.
So, are index funds really the safest way to invest? For years, everyday retail investors like us have been assured that passive index funds are the ultimate safe harbor. I mean, literally everyone from your company's HR rep to legendary investors like Warren Buffett tout the sheer brilliance of the index fund. Low fees, instant diversification, steady long-term growth. It's actually a fascinating quirk of human behavior if you think about it. We will gladly spend 3 solid weeks researching which flat-screen TV to buy, comparing the specs, reading every single review, yet we just automatically route tens of thousands of dollars into retirement accounts without a second thought. We just assume the underlying system is inherently stable. But what if that conventional wisdom completely flips reality on its head? What if the safety of the index fund is actually a grand illusion built on a structural flaw?
Section 1. The Safe Investment Myth.
To truly grasp the magnitude of this risk, we first have to unpack this concept of blind money. Essentially, this is capital that gets invested automatically into the stock market with zero human oversight, and crucially, without any regard for underlying company fundamentals. Imagine, just for a second, walking into a massive car dealership completely blindfolded and deciding you're going to buy a car based solely on which vehicle is the heaviest. You aren't checking the engine, you aren't looking at the crash test ratings, you're definitely not reading the warranty, and you are absolutely not negotiating the price. You're just blindly trusting that sheer size equals quality. Well, that is precisely what's happening in the global stock market right now. Capital flows in, entirely ignoring the traditional rules of investing. It simply doesn't care about a company's profit margins, its debt load, or if its leadership team is actually competent. It's just a giant fire hose of cash spurring into the market with a blindfold on.
Moving on to Section 2. Enter the blind money.
$13 trillion. To put that completely staggering amount of capital into perspective for a minute, $13 trillion is roughly equivalent to the combined gross domestic product of Japan, Germany, and the United Kingdom. All of that economic weight, literally entire nations' worth of wealth, is currently locked up in passive funds, acting as this unthinking, unfeeling autopilot for the global stock market. It's a colossal machine allocating fortunes every single trading day, and absolutely no human being is stopping to check if the investments actually make sound business sense at their current price points. We've effectively handed the keys to the global economy over to a massive algorithm that only knows how to press the buy button, just assuming the underlying market will sort out the details.
To understand exactly why this creates such a systemic vulnerability, let's look at the stark contrast with the old-school approach, fundamental investing. Now, this is the world of financial analysts, intense earnings calls, and poring over really complex balance sheets. The entire goal here is true price discovery. It's putting in the actual human effort to figure out if a company is healthy, if they're building innovative products, and if they're generating real profits. Passive investing entirely abandons this human element. The algorithmic autopilot just ignores the balance sheet entirely and buys stocks blindly, based solely on their market capitalization size. That means instead of buying a stock because the underlying business is actually thriving, this $13 trillion machine buys a stock simply because it's already massive.
Which brings us to Section 3, the size feedback loop. Think about what actually happens when your automatic contribution hits your retirement account every 2 weeks. Step 1, the passive fund takes that money. Step 2, it blindly buys the largest stocks in the index. But here's the catch. Because millions of people are doing this at the exact same time, billions of dollars are forcibly pushed into those specific, massive companies. That intense buying pressure artificially drives the stock prices of those companies up. And here is where the math really traps us. Because their stock price goes up, their market capitalization gets even larger. So when your next paycheck clears 2 weeks later, their newly inflated size mathematically forces the index fund to allocate an even bigger percentage of your money to those exact same companies. The big get bigger purely because they are big. It's this relentless, self-fulfilling prophecy that fundamentally decouples a stock's price from its actual business performance.
Section 4. A top-heavy, fragile market. Okay, so what does this actually build?
Well, because these stocks are continually purchased completely regardless of fundamentals, and the absolute largest companies absorb the lion's share of the capital just by virtue of being huge, we end up with a highly top-heavy system. Picture an inverted pyramid balancing precariously right on its absolute tip. That is the structure of a market driven almost entirely by passive flows. I mean, sure, it looks majestic, towering, and stable while the blind money is flowing in and pushing it endlessly upward, but it is fundamentally fragile. Honestly, it's like a giant Jenga tower where the foundational blocks of actual, critical price discovery have been systematically removed over the last decade. We're essentially trusting our collective financial future to a momentum machine, one that blindly assumes the macroeconomic weather will always be perfect and the cash will literally always keep flowing in.
So what happens when the blind money actually runs out of buyers? If this entire ecosystem relies on a never-ending waterfall of blind cash pushing the biggest stocks ever higher, what occurs when the demographics inevitably shift? Right now, roughly 10,000 baby boomers are retiring every single day in the US alone. We are rapidly approaching a massive transition from a generation accumulating wealth and pouring blind money into the market to a generation distributing wealth and actively pulling it out to fund their retirements. If the algorithmic autopilot is forced to start continuously selling the biggest companies simply because retirees need cash, well, that same mathematical feedback loop we just discussed, it starts working in reverse. It's a provocative, deeply chilling question to consider the next time you glance at your own seemingly safe, automated retirement portfolio.